So have you ever felt like your student loans are putting that dream of owning a home just completely out of reach? I get it. From trying to figure out lender rules to understanding all your repayment options, it can totally feel like you have to choose between your past and your future. But what if that's a false choice? What if you didn't have to choose? Let's dive in.
Yeah, if you're nodding along right now, trust me, you are so not alone. It's honestly one of the biggest financial hurdles people face today. You work hard, you save up what you can, but that student loan number, it's like the elephant in the room every time you even think about applying for a mortgage. And this right here, this visual really shows why it feels that way. It turns out the research backs this up. The debt-to-income ratio, which, yes, absolutely includes your student loans, is the single biggest reason mortgage applications get denied. So yeah, it's not just in your head. It's a real statistical thing.
So let's get right to it and properly introduce the main character of our story. Or maybe we should call it the main villain, the DTI ratio. Because honestly, understanding this number is the very first step to beating it.
So what exactly is it? Well, your DTI is actually pretty simple when you break it down. You just take all your monthly debt payments, we're talking car loans, credit cards, and of course student loans, and you divide that by your gross monthly income, which is your salary before taxes. It's basically the go-to metric for lenders to figure out, hey, can this person really handle another big payment every month?
So, what's the magic number? Well, it can vary a bit, but for the most part, lenders really want to see a back-end DTI of 36%, or ideally even lower. Once you start creeping up much higher than that, lenders get nervous. And that student loan payment, whether it's big or small, plays a huge role in keeping you under that line.
But here's the good news. You are not powerless here. You actually have this amazing toolkit you can use to manage that student loan payment and get your DTI down. Let's talk about the Federal Income-Driven Repayment Plans, or IDR for short.
And this is the absolute key. See, a standard plan calculates your payment based on how much you owe, but IDR plans flip that script. They look at your income and your family size, and they set your payment as a percentage of your discretionary income, which is just a fancy way of saying it's the money that government thinks you have left over after you've paid for the absolute basics. This one change can slash your monthly bill and, you guessed it, your DTI.
Okay, so check this out. What's so cool here is you can literally see how these plans have gotten better and better over time. We started with IBR at 15% of your income. Then Pay came along and dropped it to 10%. But then look at the new Save plan. It can be as low as 5%, it protects way more of your income, and get this is a total game changer. It comes with a full interest subsidy. That means if your payment isn't enough to cover the monthly interest, the government just wipes away the rest. Your balance can't grow.
Yeah, that interest thing alone is why we're calling the Save plan a real game changer. It fundamentally changes the math for borrowers. So let's take a closer look at what makes it just so powerful.
I mean, the benefits here are just wow, because it protects so much more of your income from the calculation. We're talking about millions of people who now have a $0 monthly payment. Seriously, zero. And like we just said, that interest subsidy means your loan balance won't balloon, even with that $0 payment. On top of that, if you have a smaller original loan, you could see your debt forgiven in as little as 10 years.
Okay, so let's picture this. You do everything right. You get on the Save plan, your payment plummets to zero, your DTI looks amazing, you're ready to go house hunting. Sounds perfect, right? Well, not so fast. There's this hidden catch, this little paradox that could completely stop you in your tracks.
And we're calling it the $0 payment paradox. Here's the deal. You have an official, government-approved monthly payment of $0. But when you go to apply for a mortgage, some lenders are going to look at that and basically say, nope, we don't believe you.
And this is where it gets really tricky, because it turns out not all mortgage lenders play by the same rules. So look, if your loan is backed by Fannie Mae, you're golden. They use your actual $0 payment, which is exactly what they should do. But for loans backed by Freddie Mac or the FHA, oh boy, they just ignore it. They calculate a phantom payment of 0.5% of your loan balance every month. And for VA loans, it could be even worse. This one little rule can artificially blow up your DTI.
Let's put some real numbers on this so you can see the damage. Okay, let's say with your actual payment, $0, your DTI is a pretty solid 38%. You're comfortably under that 43% limit for a qualified mortgage. You should be good to go.
But then you go and apply for an FHA loan. That lender looks at your file, crosses out the zero, and pencils in that phantom payment we talked about. And just like that, poof, your DTI shoots up from 38% to 44%.
you're over the line. Application denied. And it's all because of a payment you literally do not make.
And you know what the most frustrating part is? There's no good reason for them to do this. It's not really about risk. Fannie Mae themselves spelled it out perfectly right here. The only way your IDR payment ever goes up is if your income goes up first. So this idea that a $0 payment today is some kind of future danger, it just doesn't add up.
All right, let's switch gears and fast forward a bit. Imagine it's 20 or 25 years from now. You've been diligently making your affordable IDR payments, you've played by all the rules, and you're finally approaching that finish line, loan forgiveness. But there's one last thing you got to keep on your radar.
So here's how it works. Right now, through the end of 2025, any student debt that gets forgiven is tax-free, which is awesome. But here's the catch. After that, the old rules might kick back in. And under those rules, the IRS could see that forgiven loan balance and treat it just like income you earned that year. And that's the infamous tax bomb.
And let me show you just how big of a deal this could be. So on the left, you've got a family with a taxable income of $100,000. They owe about $4,000 in federal taxes. Manageable. But now look at the right. Let's say they get $50,000 in loans forgiven that year. Bam! Their taxable income jumps to $150,000. And their tax bill? It more than triples to around $13,000. That's a huge check to write all at once.
Okay, so after hearing all that, you might be thinking, what am I supposed to do now? But look, the point of all this isn't to scare you. It's the opposite. It's to arm you with the right info so you can outsmart the system and build a solid plan.
So here's your playbook, your key takeaways. First, get on the right IDR plan. For almost everyone listening, that's going to be the SAVE plan. Second, and this is so important, when you're mortgage shopping, you need to ask this question point blank. How do you calculate DTI for a $0 student loan payment? That's how you find lenders who use the smart Fannie Mae rules. Third, start thinking about that potential tax bomb now. Even saving a little bit each month can make a massive difference down the road. And finally, a super important little side note, if you're on track for public service loan forgiveness, that money is not taxable, so you're in the clear.
So at the end of the day, you got to stop thinking of your repayment plan as just another bill. It's not. It is a powerful financial tool. When you understand the rules, the weird loopholes, and the long-term game, you can use it to not just manage your debt, but to actually build the future you want. So the question really isn't if you can buy a home anymore. It's about how you're going to use this tool to make it a reality.